The Board of Governors is the top decision-making body of the ESM. It comprises 17 finance ministers of the euro area. They meet on a regular basis anyway as a Eurogroup on a monthly basis, but once a year they meet to look at the business activities of the ESM of the preceding year and to approve the annual report. The EFSF supports the macroeconomic adjustment programs in Ireland, Portugal and Greece. The ESM, which was created in October 2012, supports the bank restructuring in Spain and the new Cyprus program. So EFSF will come to an end, will not provide new loans, new programs, but the ESM is a permanent institution, has a firepower, total lending capacity of 500 billion euros. So far, the ESM has only used about 50 billion for Spain and Cyprus, so 90% or 450 billion euro is still left. The interest cost for our member states that borrow from EFSF or ESM are all calculated on the same basis. They reflect our funding cost and a very, very small margin for the administrative cost. The cost is low. We benefit from our very good rating in the markets. We can raise funds at very low rates. At the short end, even negative sometimes. Short for the longer term bond issues, we pay around 2%, 1.9% for 10-year government bonds. All these different maturities are then added up. We calculate on a daily basis the average cost of funding, and this is immediately passed on to the countries that borrow from us. We know our member states very well. Before countries receive money, the European Commission, also the IMF, make a so-called debt sustainability analysis to be sure that these countries are in a position to pay back. And the most important aspect of our lending operation is that money is only given in exchange for so-called conditionality. Conditionality means countries have to promise to change their economic policies, to improve their economic policies, implement structural reforms, have fiscal consolidation, with the objective of improving the economic fundamentals so that a new basis for sustainable growth is created in each country. Banking union addresses our most serious problem at the moment. A banking union has several elements. The first one is decided. The ECB will take over the supervision of the largest and most important European banks. That's an important first step. Then there are other elements which are still under discussion. One is the possibility for the ESM to recapitalize banks directly. This may be decided very soon, but would only become effective if and when the ECB is playing fully its role as common supervisor. The other elements are a bank resolution mechanism, a bank resolution fund, and also the harmonization of deposit insurance schemes. These steps will take a bit longer. They are under discussion and we are waiting for proposals from the European Commission. It is important because at the moment we see that the European banking market is fragmented. We have seen a renationalization of banking, and this is costly because the countries in Southern Europe face a situation where borrowers have to pay significantly higher interest rates than comparable borrowers, also in the private sector in Northern Europe. This is a burden for real economic developments, and the European Central Bank is trying to improve the monetary transmission mechanism in order to bring this to an end.